SoFi Technologies, NASDAQ, SoFi, is currently trading around 25.54, reflecting a modest intraday pullback, but standing as a testament to its remarkable ascent. The stock has surged from its 52-week low of 6.75 to a high of 26.61, a meteoric rise that has captured the attention of every investor with an eye on fintech. On the surface, the narrative is simple and powerful. A digital-first challenger bank is successfully executing its growth strategy, adding millions of members and products, and finally, achieving profitability. But here's the unaddressed paradox that the market hasn't fully grappled with. SoFi's success is not just about its member and product growth, which are undeniably strong. The true underestimated driver of its valuation is the strategic and often misunderstood pivot toward a capital-intensive banking model. While many still view SoFi as a scrappy fintech disruptor, its recent actions and financial statements paint a different picture, that of a burgeoning financial institution, and that shift reframes the entire risk-reward profile, raising new questions about its path forward. The market's expectation is that SoFi is a high-growth tech stock. The reality, however, is that it is a hybrid model, a fusion of technology and traditional banking, where the long-term value is tethered to a delicate balance of loan growth, deposit stability, and efficient capital allocation. The core of the common narrative around SoFi revolves around its Galileo platform and its growing lending business, with personal loans being the primary engine. In its most recent quarter, SoFi's revenue growth accelerated, driven by a record quarter for its financial services segment and a substantial increase in its lending business. The company's strategy of cross-selling products, getting a member to sign up for a checking account, a credit card, and a personal loan is working. This is the flywheel effect that management consistently highlights, and it's a powerful narrative. They are not just acquiring customers, but deepening their relationship, which in theory should lead to higher lifetime value. The numbers seem to back this up. Member growth is in the millions. Products are nearing double-digit millions, and the company has finally turned profitable. Yet, what the market often overlooks in its excitement is the underlying capital structure that enables this growth. The shift to a bank charter has been a game-changer, allowing SoFi to fund its loans with its own low-cost deposits rather than relying on more expensive securitizations or debt. This is the single most important factor in its journey to profitability and its ability to scale. However, it also introduces a new set of dynamics that are fundamentally different from a pure tech company. As a bank, SoFi is now subject to more stringent regulatory oversight, capital requirements, and interest rate risk. The ability to manage its net interest margin, NIM, becomes paramount, and this is where the deeper analysis begins. The profitability is real, but it's a tightrope walk. SoFi has to continue to attract and retain deposits at a competitive rate to fuel its lending machine. Any significant change in the interest rate environment or a loss of consumer confidence could severely impact its ability to grow and maintain that profitability. This is the tension. The market is not fully appreciating the brilliant strategic move of becoming a bank also comes with the baggage of a highly regulated and cyclical industry. Expanding on this, let's dissect the macro-level factors and how they directly impact SoFi's micro-level execution. We're in a period of economic uncertainty, with inflation and potential recessionary pressures still looming. For a traditional bank, a downturn in the economy can lead to higher loan defaults, a tightening of credit, and a compression of NIM. SoFi, with its prime credit borrower base and focus on personal loans, is more resilient than a subprime lender, but it is not immune. The question is not if a recession will impact them, but to what extent. The company's ability to maintain its underwriting standards while continuing its aggressive loan growth is a critical balancing act. SoFi's technological advantage, particularly its ability to use data-driven models for underwriting, is its key defense. The company can, in theory, adjust its risk models in real time, offering a more dynamic response to market conditions than traditional banks with their legacy systems. This is the true power of the tech in fintech. But a model is only as good as the data it's trained on, and a major economic event could introduce unforeseen variables that challenge even the most sophisticated algorithms. For instance, what happens if a significant portion of its prime borrowers lose their jobs? Their ability to service debt would be impacted, and SoFi's superior underwriting could face its ultimate test. This is a risk that the market, high on the fumes of profitability, seems to be discounting. The contrarian view is that SoFi's rapid growth is happening during a favorable credit cycle, and the real test will come when that cycle inevitably turns. The company's recent filings show that while its net charge-off rate is manageable, it is not zero, and a broader economic slowdown could see this number tick up, directly hitting the bottom line. The second, and arguably stronger, insight is buried within the subtle evolution of SoFi's business model beyond just lending and deposits. The company is actively building a three-pronged revenue model: lending, financial services, and its technology platform. While lending and financial services are the most visible parts of the business, the technology platform, anchored by Galileo, is the silent engine that could unlock a different kind of value. Galileo provides core infrastructure for other fintechs, essentially selling the picks and shovels during a gold rush. This is a high-margin, less capital-intensive business, and it provides a valuable hedge against the cyclical nature of the lending business. The market understands this segment in principle, but the true significance lies in its strategic role. Galileo's success is not just about its revenue. It's a signal that SoFi's technology is not just for internal use. It is a best-in-class product that other companies are willing to pay for. This validates SoFi's claims of being a tech company and provides an alternative, more stable, and scalable revenue stream. Furthermore, the acquisition of Technisys, a cloud-native banking platform, was a brilliant and underappreciated move. It allows SoFi to offer a comprehensive, end-to-end tech stack to financial institutions, from core processing to digital banking solutions. This turns SoFi from a competitor to a partner for some of its peers. This dual-sided approach, growing its own consumer-facing business while simultaneously selling the underlying technology, creates a powerful network effect. It allows them to reinvest the high-margin tech revenue back into marketing and member acquisition for their lending and financial services segments, creating a self-reinforcing loop. This is a sophisticated strategy that goes far beyond the simplistic "they're a bank now" narrative. The reality is that SoFi is building an ecosystem, and the sum of its parts may be far more valuable than the market's current siloed valuation of each segment. The profitability of the lending segment is a fantastic achievement, but the true long-term value may be found in the sustained growth and high margins of the technology platform, which provides an essential layer of stability and diversification. This is the reason why the stock's valuation, despite being higher than many traditional banks on a price-to-earnings basis, can be justified. It's not a bank, it's a technology company that happens to have a bank charter, and that distinction is paramount. The strategic genius of SoFi's CEO, Anthony Noto, cannot be overstated in this context. His background at Twitter, Goldman Sachs, and the NFL gives him a unique blend of tech, finance, and marketing acumen. He is not just running a bank. He is running a brand. The "Get Your Money Right" slogan, the sports stadium naming rights, and the aggressive marketing campaigns are not just about customer acquisition. They are about building trust and brand equity, which are priceless assets in a crowded and competitive financial landscape. The expectation is that a CEO is simply managing the day-to-day operations. The reality is that Noto is orchestrating a cultural shift, trying to build a new kind of financial institution that resonates with a younger, tech-savvy generation that has a deep distrust of traditional banks. This focus on brand and community is a competitive moat that is difficult for competitors to replicate. It's not just about a better interest rate or a lower fee. It's about a sense of belonging and a brand that aligns with their values. This human element of the business is often lost in financial models and earnings reports, but it is a fundamental driver of SoFi's ability to maintain high member retention and continue its cross-selling success. The fact that the company has now achieved a P/E ratio that reflects its new profitability is a significant milestone, but what the market is still struggling to quantify is the value of this brand and the strategic vision of its leadership. This is a management team that is not afraid to make bold, unconventional moves, from acquiring a bank charter to buying other tech companies, and their willingness to take calculated risks is a key differentiator that should not be overlooked. In summary, the story of SoFi is a masterclass in challenging and ultimately subverting market expectations. Investors came to the table expecting a high-growth, high-burn fintech story, but what they received was a well-executed strategic pivot into a hybrid